The Australian Financial Review.
Hello, I'm Anthony Macdonald, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, and for her second ever appearance on the pod, she's the AFR's editor, filling in for my old mate James Thompson. It's Cosima Marriner. How are you, Cosy?
I'm well, thanks. And thanks for having me back.
This week, we're going to consider whether 5% deposit home loans are good for first home buyers. We prepare to say goodbye to another Australian media legend and take a question on Australia's big corporate tax dodgers. But first, Cosima, the big business story of the week. China's steelmakers have stopped buying BHP's iron ore. Cosy, this one landed with a thud. BHP mines nearly 300 million tonnes of iron ore in WA's Pilbara, whacks it straight on a boat, sends most of it straight to China. These iron ore exports are Australia's biggest exports. They prop up Australia's terms of trade and budget. If China's not buying what BHP's selling, are Australia's glory days over?
Well, look, Ant, we were all very shocked when the news broke on Tuesday evening that China had slapped a ban on BHP's shipments of iron ore into the country. And look, it is a big deal. As you said, iron ore exports are one of the, excuse the pun, bedrocks of the Australian economy. It brings in more than $100 billion a year. And we sell 80% of our iron ore, which is used to make steel, to China.
Yeah.
If China stops buying out iron ore, that has massive implications for the Australian economy. It's why Treasurer Jim Chalmers felt compelled to get a private briefing from BHP boss Mike Henry about what was going on. And even the Prime Minister, Anthony Albanese, weighed in, saying he wanted the dispute resolved quickly. Now, look, BHP is refusing to comment. They say it's, commercial in confidence. But most people think the ban is simply China playing hardball here in its contract pricing negotiations with BHP. And look, as of yesterday, ships full of iron ore from the Pilbara were still leaving Port Hedland in WA. So BHP must be pretty confident that the standoff will be resolved by the time the boats arrive in Chinese waters. So we're not quite in the same territory as we were a few years ago when China banned lobsters, wine, coal from Australia, when diplomatic tensions between our two countries were high. But I think we'll all feel a lot more comfortable when we know that the Chinese say, come on back in iron ore.
Oh, totally. Because I've barely slept all week. That's a billion tonnes of iron ore, that we ship out of the Pilbara every year. Close to a third of that's BHP. Like, they're massive volumes. And we've got a list of our top corporate taxpayers this week, and we'll get to that later. But more than half of the corporate tax take, it's coming from the mining and energy giants. Rio, BHP, Fortescue in that order, I think were the top three. You add in the royalties. That's compensating Australia for digging up our rocks, basically, and selling them. These guys are hugely important. And like you said, it's interesting. This one just went straight to the PM and the Treasurer, didn't it? Like, how many other issues do we see that just get escalated so quickly? Well,
normally you'd expect them just to say, we can't comment on commercial business negotiations. It has nothing to do with us. But actually, it has everything to do with the health of our economy. And that's why they're on the phones pretty quick smart.
Yeah, I reckon this is the sleeper issue we have to watch out for, Cosy. Like, we've been skirting through this US-China trade war all year as if we're not involved, nothing's happened, we're fine, we can play both sides. But like this one, it's the one that's going to come back and get us at some stage. And I know there's been commentary this week saying that, China's going to blink first and BHP's going to be fine. But, mate, one day it's not going to be like that. I just hope we get through this one.
Absolutely. Now, and on a slightly different matter, it's not a chook pod without some rates chat, and I love rates chat. The RBA Monetary Board kept rates on hold this week, but the real action was in the press conference afterwards when the Governor, Michelle Bullock, spoke. Did she give us any hints about what's coming next?
She played the straightest of straight bats. Cosy, as usual, Australia could use an opener for the Ashes series this year, and if Michelle Bullock was available for selection, I reckon she'd have an impenetrable defence. These rates days, they all have their own story. July was rates are coming down, it's just a matter of when. August was the productivity assumption downgrade, but everyone left that meeting sort of thinking there were 3 more cuts coming in the next 12 months. From this one, I reckon forecasts are moving towards 1 more cut in the coming 12 months, Cosy. We could be at the top of the rate cutting cycle, which would be amazing if we are, and it'd be a really, really, really quick rate cutting cycle from a historical context. But expectations have definitely been dampened. I mean, the RBA is so deliberate. Michelle Bullock's so deliberate in everything they say.
Yes,
you think that's the message they want us to take.
I definitely do. And it is so interesting how quickly it seems the conversation has changed around interest rates. And the governor pointed to what the Financial Review actually reported on earlier last week, which was Australia's labour costs, which is the gap between, how fast wages are rising and how well productivity is growing, has grown quicker in the past 3 years than it has in the past decade. And what that means is that then businesses, when they're looking to try and make some more money, they think about raising prices for consumers. So prices start going up, inflation starts going up, suddenly the interest rate challenge becomes even harder. And that's what Michelle Bullock sort of called out as a bit of a watch for the next few months.
100%. We're sort of, we're quite constrained at the moment, and constrained by our own ineptness and smallness and lack of productivity. But, Cossie, I think we have to start thinking about 3.6% cash rate. What's Australia look like at 3.6%? 3.6% for cash rate. I'm paying 5.34% on the mortgage. That's historically, for the past 10 years at least, that's really quite high. But if you look back anything further beyond 10 years, that's really quite low. Right?
It is. I remember when we bought our first house, which was in, I think it was 2008, and our interest rate was just under 5%. So if you take a longer view, it's not that high, but it feels very high for anyone who's bought a house, in the last decade, as you say. Yeah,
so we came away from the meeting. I think the message from her and for all of us is basically just get on with it. we're not going to do it for you anymore. Rates are where they are.
Well, it also brings to mind, where have we gone with productivity post the government's economic roundtable, which was supposed to start the conversation about fixing productivity. We had a few things come out of that: freeze the National Construction Code, get law reform moving. It's gone a bit quiet since.
Road user charging.
Well, as you know, this week, the government's walked well back from that, because we've got the Climate Change Authority saying if we're going to hit our new 2035 targets, over 50% of new cars need to be EVs. There's ministers in the government like Chris Bowen, the Climate and Energy Minister, that doesn't want any deterrent to uptake of EVs, and he's worried that you put a road user charge that will deter people from buying them. So Jim Chalmers said this week, you know what, we're in no rush to introduce that road user charge. And then you've got a New South Wales Premier, Chris Minns, and Victorian Premier Jacinta Allen saying, hang on, we got a lot of potholes we need to fix here. We need a road user charge. As more and more vehicles transition to EVs, we get less revenue from petrol tax. The government's got to fix that.
All right, Cossie, for our first topic, let's dive into something that is actually happening, and that's the government's home guarantee scheme, which got underway this week. First home buyers, as long as they're Australian and either haven't owned a home before or haven't owned one in the past 10 years, they can buy a home with only a 5% deposit and not have to pay lender's mortgage insurance up to a certain price. Now, in Sydney, Cossie, that cap is $1.5 million. In Melbourne, it's $950,000, and in Brisbane, it's $1 million. This was an election promise by the Labor government. It's good to see it follow through on an election promise, particularly after such a resounding win. But do you think this is good policy or not?
Look, Anne, I've got 3 kids. I want them to be able to buy their own home somewhere, within driving distance of where their parents are. My 15-year-old son has actually asked me on more than one occasion if I think he'll be able to buy a place in the suburb he grew up in. And I don't know the answer to that at the moment.
Yeah.
But look, I got to say this policy isn't great. It's going to inflate demand and therefore house prices. And we know that Australian property is already amongst the most unaffordable in the world. And it comes at a time when we've already got a price upswing. House prices rose by 0.8% across the country in September, which is the largest monthly gain since October 2023. So there's already a bit of heat coming back to the market. Now, the Prime Minister sort of said Treasury estimates that this expansion of the scheme, the 5% home deposit scheme, will only push up property prices 0.5%. But that's across the entire Australian housing market. And as our property reporter Lucy Slade wrote yesterday, house prices in suburbs where first home buyers will be looking, they're likely to go up more than 0.5% because you've got a lot of people suddenly crowding into a certain number of suburbs, which means that then they're going to be priced out of those suburbs even quicker and pushed even further out from the city. And then if you look on the other side of the equation, you've got demand being pushed up, but then what's happening on supply? Now, the government's sort of answer on the supply front is their goal of building 1.2 million new homes by the end of the decade. But that's looking increasingly unachievable. We're tracking about 180,000 homes short of that target at the moment, and the government's taken to calling that an aspirational goal. So the gulf between what we can buy and how much it's going to cost seems to be getting bigger.
I'm just amazed you got a 15-year-old that wants to live in the same suburb as Cossie. My parents have 4 kids and we each went north, south, east and west, respectively.
Well, it's nice for us. Now, look, and what have house prices been doing, and how much do you think this, home guarantee will change their trajectory?
Oh, they only ever go one way, don't they, Cossie? I mean, they were up 0.9% in September, 4.3% on a year-on-year basis. I mean, that's the strongest increases we've had in the past 12 months. They were up highest in Perth and Brisbane in September. It's pretty amazing. The trajectory is up and to the right, a bit like your career or Nvidia's share price. I mean, the number that caught my eye this week and what's fueling it is just the buying power of Australians. So Morgan Stanley strategists reckon the buying power of Australians is up 17% in the past year. So basically, if you consider what's happened to interest rates, if you consider what's happened to wages and the cost of living, people can afford to pay 17% more for a home this year than they could last year. Now, that's amazing. So if you can afford to pay 17% more and you're stuck in this rat race mentality like most of us seem to be and willing to pay more when we have to, plus you got population growth, you got immigration, you got steady jobs market, you got heavy government spending, how do prices not keep going up? And now that we're pouring fuel on the fire, well-intended fuel for sure, getting young people into the housing market, for me, that's a core Australian value, and home ownership, if you want it, is a great thing. But this scheme, it's unlimited places, no income caps, higher price caps.
I can't believe that the price cap is higher in Brisbane than in Melbourne. That tells you a lot about what's going on in the Brisbane property market at the moment as they head into the Olympics.
100%. First home buyers account for about 1 in 5 new loans. Like you say, if you've got this big increase in demand without the supply side response, it's just hard to see how things don't get even more out of control, particularly the way that 1.2 million homes target is tracking. Just say young people do rush to take this up, and I wouldn't begrudge them if they did. I've got no ideological opposition to using the government balance sheet to helping young people out. Where does that leave them going forward? How stretched are they going to be? And then what's the impact of that on the country's economic policy for the coming generation if you've got these people that have bought homes that by any normal definition they couldn't afford or they wouldn't have got finance for? Where does that leave them in relation to the government and their relationship with the government? So I'm a bit worried about it too. But what do you think this is going to do for politics, Cosima? I mean, is this about Labor trying to buy young people's votes? I thought they already had most young people's votes. So what's going on that sort of politics side?
As you say, it is good to see the government fulfilling one of its key election policies. And as we know, Anthony Albanese is very focused on delivering his second-term agenda. And look, this, 5% deposit is a policy that's squarely aimed at those young voters, and they're already much more likely to vote Labor than the coalition. Redbridge polling that we recently reported on showed 33% of Gen Z support Labor compared with 18% of the coalition.
Wow, yeah.
But you know what? You got to keep turning up for these voters. Labor's still got to win another election in a couple of years, and even though it's got a massive majority, it wants to make sure those voters are locked in. And then you look at their parents, boomers and Xers like me, they're also concerned about housing affordability because they're looking at their kids, like I am and you are, and worried that they are actually going to be the first generation that's worse off than the one that came before it. So they know that particularly if you don't have access to the bank of mum and dad, getting into the housing market, which is still a core tenet of the Australian dream, if you can't get into that housing market, that's a massive concern. So policies that address housing affordability, they also resonate with older voters who are already homeowners. But I think the economic rationalists amongst that cohort do not think that this 5% deposit scheme is the right way to go. And then when you think about it, you got banks right now, or as of pre-Wednesday, if you bought a home and you were a first home buyer or anyone, if you don't have a 20% deposit, you've got to take out lender's insurance, right? Now, the government for first home buyers that, buying under that cap, the government's basically giving them free lenders insurance, right? You only just need that 5% deposit. So what does this policy mean for banks?
It's great for the banks. They can write bigger loans, basically. 30-something banks have piled into this scheme. Cosima, they love it. They'll be happy as Larry. They can lend people more for the same amount of risk or perhaps a bit less. It's good for the loan book growth at a time when they're under pressure to grow loans. What will be interesting for the banks is how this skews their new loans between owner-occupiers and investors. So this scheme's only aimed at owner-occupied homes, obviously. So 60% of CBA's new business in the financial year just gone was for owner-occupier homes, 40% for investors. Just wonder whether this skews things further towards that owner-occupier route, or do the investors fight back and the two sides get in a war, just drives up prices even more? And we realise that there's this whole butterfly effect thing going on, that you can't tinker with one policy setting without just basically impacting everything.
Well, it's true, and it's interesting you call out the property investors because they've actually come back into the market with a vengeance in the last 6 months. The RBA's recent financial stability report that came out, I think it was yesterday, showed that credit growth for housing investors has ramped up 6.6% since April.
Wow.
Since we've got into that interest rate cutting cycle, whereas growth in credit to owner-occupiers is only growing at 5.7%. So you've got these two different influences coming into the market at the same time. It'll be interesting to see how it plays out.
Scary.
Very scary. On to our second topic. Let's look at the big M&A deal of the week. Southern Cross Media, which owns FM radio stations nationally like Triple M and the Hit brands, has a deal to buy Seven West Media, which is another listed media company that owns the Seven Network TV stations and the West Australian newspaper, and it's controlled by billionaire Kerry Stokes. Now, these two companies are going to come together, create a combined TV and radio owner with a national footprint and two digital businesses, and they want to try and take on the Netflixes and Spotifys of the world with the 7+ streaming app and the very successful Listener podcasts. And this is a deal with lots of angles. Let's start at the top. The actual M&A deal. Is it good? Is it bad? Why are they even doing it?
Well, M&A comes in a few buckets, Cosy, and this one is the old stronger together deal. You know, you have two legacy media companies heavily knocked around by the big global entrants, you know, Netflix, Disney, Apple for Seven, Spotify for Southern Cross, Google and Facebook for both of them. They're the big ones that have been eating the advertising dollars. In response, Seven West and Southern Cross, they've just cut costs and cut costs and cut costs. But they haven't been able to cut the cost as fast as the impact has been on their revenue. So their earnings are under massive pressure, share price under pressure. So once you cut most of the costs and you still got grand plans to offer this national product, and let's be honest, we all probably still have Channel 7 on the TV and know what Triple M is on the radio. So they do offer, you know, a service that a lot of Australians consume. They've got to do something. So they're going for scale. They're trying to do it cheaper and bigger, try to have a more diverse and bigger sort of product or group of products to take to their clients, which are the advertisers, and try and suck up more advertising revenue that way. So I think there's general recognition the deal makes sense, like the consolidation bit. But life won't get much easier, or maybe even any easier, for Seven West or for Southern Cross. I mean, just because they're together, it doesn't diminish the competitive pressures on both of them. So I'd say it's a good deal. It's a logical one, you know, but the why they're doing it, which is to ease the pressure bit, there's no quick fix. You know, it might save them $25 or $30 million a year. They reckon in running the business, but it doesn't mean that necessarily that they're going to be able to pinch back a lot of the advertising dollars that they've lost. And really, if they want to return to the glory days, that's what they need to do. But the thing that really caught our eye about this deal, Cossie, was Kerry Stokes. He's been involved with the Seven Network for about 30 years, Australian billionaire, big name, big businessman. He'll leave the combined group's board in February, which basically ends his jobs in Australia's public capital markets. Now, how important is Kerry Stokes in Australia, and what's his legacy?
It's definitely the end of an era, Ant.
Yeah.
One of my first jobs in journalism, which was at the turn of the century, was being the media and telco reporter for the Sydney Morning Herald. And back then, all the big stories revolved around the three media moguls, and that was Rupert Murdoch, Kerry Packer and Kerry Stokes, and how they jostled for power and influence via their various interests in publishing and broadcasting. And Stokes was the junior mogul back then. He was often portrayed as the underdog, which I think he quite liked. But then Kerry Packer died in 2005. His son James got out of media, became more interested in casinos. Rupert and his son Lachlan became increasingly focused on the global News Corp business.
Yeah.
And so Stokes sort of became the last kind of Australian-focused media baron. And unlike Packer and Murdoch, who inherited businesses from their fathers, Stokes is actually a self-made man. He came from very humble beginnings. He grew up in a poor area of Melbourne. He left school at 14. He had dyslexia. And then he moved west to fix TV aerials at the age of 19. So he actually started on the tools in broadcasting. And he bought the Seven Network in 1995, and then he pulled off a bit of a bold takeover of the West Australian newspaper in 2008. So, as you say, for 30 years, he's loomed large over the national, cultural and political conversation in Australia, particularly in WA, which is a one newspaper town, where he's been the driving force of their very famous telethon, which has raised lots of money for sick kids. And he's also via Seven given us the long-running soapy Home and Away. We've got the AFL that we watch on Seven and the very popular My Kitchen Rules, which has spawned a bunch of other cooking shows. And look, he's also been active in other areas. He was a big supporter of now war criminal Ben Roberts-Smith in his defamation fight with Nine, which is the owner of the Financial Review. So he's had a lot of influence in a lot of different spheres. But with this merger with Southern Cross, Kerry's turned 85 only a few weeks ago. Officially, he's stepping back from media. You know, the era of the media baron is kind of done now in Australia. The chairman of Southern Cross, who will succeed Kerry, is chairman of the merged business, and it's not his son Ryan, who's the chief executive of the broader Seven Group that owns Kerry's interests in Seven West Media. Now, as you know, Ant, Ryan doesn't have a big emotional connection to media the way his father did. He's a pretty cool customer. I know you've got a lot of time for him, and he's much more interested in growing the other more successful businesses that Seven Group owns, like Boral and Westrack, rather than propping up a struggling media business. So, as you have mentioned, all the challenges that are going to face even this merged entity, I don't know that Ryan's going to be particularly interested in spending a lot of time on them. What do you think?
Yeah, I agree with you. I mean, he seems pretty by the numbers, and he would look at SGH and what SGH owns, and the biggest business by, multiples of 10s, 20s, 100, Westrack, Coates Hire, Boral, and a stake in Seven West Media. I mean, that's a legacy asset for the group. It's something that I'm sure Ryan would be disappointed that they haven't been able to do better with, just because of the pressures it's faced. But I'd be surprised if he spends much more than 5 or 10% of his time worrying about that compared to the much bigger businesses that are actually driving SGH's earnings.
And probably have a lot more upside. Yeah. Now, Anne, this deal also had some investors pretty hot under the collar. Can you tell us a bit about that?
Oh, it was so hot. Like, it just reopened this festering wound that's out there in Australian institutional equity markets at the moment. So the way this deal's set up, Southern Cross is acquiring Seven West using shares. So it's offering 49.9% of the combined group to Seven West shareholders. Now, Seven West shareholders, they'll get to vote to approve the transaction. That shouldn't be a problem because the Stokes's are saying, yep, all good. But Southern Cross shareholders do not get to vote. And why? It's because it's giving away 49.9%, not 50%. So this is like if you have a 4-bedroom, 2-bathroom house, Cosy, you're giving away 2 bedrooms, you're giving away a bathroom, you're giving away one of the car spaces, you're giving away half the lounge room, but saying that the 3-seater lounge is yours and the 2-seater lounge is someone else's.
It's a great analogy.
So you've just got a little bit more than the other people, but you don't get a vote. So it's been done deliberately, structured this way that it's 50.1% and 49.9% on the other. If it was anything more, Southern Cross shareholders would get a vote as well. And you'd have to think that vote would struggle to get up because it's got quite an unruly share register.
It does.
There's some big investors who are a bit all over the shop, to be honest. Like, it's got a bit of this and a bit of that, like very different types of investors. And I reckon it'd be hard to get them on the same page. And some of them, perhaps the loudest, don't love the fact that Southern Cross is buying back into TV. So Southern Cross always had TV, regional TV, out in the prime possum part of the world, Cosy. It's only just got rid of its regional TV stations and now it's effectively buying back TV. So it's hugely controversial. It opens up a wound that was created by James Hardie 6 months ago when James Hardie went offshore and bought this business called Azek that shareholders here went ballistic about and they're still fuming about. That sparked a review of the ASX listing laws, which is the relevant framework around these shareholder votes and when shareholders do and do not get to vote. Those listing laws are being reviewed at the moment, but the review's taking forever. And there's just concerns among investors that the ASX is slow walking its way to a nothing burger of a review, to be honest, and all this is just skewed in boards' favours, companies' favours, investment banks' favours, just this sort of like pro-deal approach from the ASX with little regard at all to whether these deals are actually good or not. It's one to watch. But, Cos, did you see the other big deal this week, also involving a billionaire, which was Eagers? So that's the big car dealer, 14% of Australia's new car sales. It's run off to Canada and paid $1 billion to expand there. What'd you make of that move?
Well, you're right, Ant. This deal has another billionaire involved, and that's Nick Politis. He's an AFR rich lister. He's worth about $2.6 billion. But he'd probably be more familiar to some of the Chanticleer listeners as the long-standing chairman of the Sydney Eastern Suburbs Rugby League club, the Roosters.
Yep.
But he's made his money in his career selling cars, and now in his 80s he's the largest shareholder of the Eagers dealership and is a director of the business, and he's got a 28% stake. Now, this is their biggest offshore move, buying 65% of Canada's strongest car dealership groups, Canada One. And as you wrote earlier this week, Eagers boss Keith Thornton says the Canadian car dealer market is a lot like Australia's was 20 years ago. There's a handful of players with 2% share of the market each and a bunch of private players. So they're pretty confident there's a lot of upside to be had and they can kind of see where the market can go because they've seen it happen in Australia. And if it works out, maybe Eagers ends up moving to full ownership of Canada One down the track, which would be a very interesting, bigger move for Eagers. So what do you know about Canadian cars, Anne?
Only what Keith Thornton, the Eagers boss, told me. and to be honest, I don't think they know that much about Canadian cars either. They've had to get up to speed on things pretty quickly. They've been a great success story in Australia, but going offshore, obviously, a bit of
its risks.
Got its risks there. The thing that is in their favour is that Nick Politis, so he owns about nearly 30% of Eagers. He's owned offshore dealerships before. And Keith Thornton, the CEO of Eagers, who's an old car salesman and just one of the smoothest salesmen you'll come across, he got me fully convinced that if you're selling Toyotas in Australia, you can do it in Canada reasonably easily. But in terms of what they drive over there, Cosima, pickup trucks and SUVs. Yeah. So the Ford F-150, Chevrolets, they're the top selling cars. The way they talk about it is this business is big in the Alberta region, which is like northwest or northeastern Australia, which has just got me picturing rugged people, rugged terrain, big cars.
Lots of blokes.
Lots of blokes probably making the car decisions. And these cars are quite expensive, and that's good when you're selling them because generally the more a car costs, the more the dealer will make. So, good luck to Eagers. It's flying the flag for Australia.
Does it need to go offshore? Is that where they need to go for growth?
Sort of, because it's got 14% of the Australian market, which doesn't sound like much, but that's actually really unique on global standards. Typically, car dealers will own up to 2, 3, 4, at most 5% of their national market. Eagers is already 3 times that level.
Yeah. It's
been growing quickly. So, yeah, it's made no secret of its intention to try and expand offshore for the past couple of years. So, good luck to them. But the main thing for them is just don't let this Canadian venture blow up what you're doing here in Australia.
Yeah.
Protect the Australian business first. Keep growing that. And if the Canadian thing works, you beauty, fantastic. But just don't let the rot set in here. That's when these transactions can really be disruptive for a company, is if you make the move offshore, it doesn't work, then management spends all their time worrying about something that's much smaller and less important. It just becomes a big distraction. The whole thing can unravel very quickly.
Indeed.
All right, Cosima, it's time for a break. We'll come back and we'll look at the big things on next week. Welcome back. Cosima, there's plenty on next week, as usual. Always a big week on the Chanticleer podcast. The first thing to watch, I reckon, is this US government shutdown. All right, started this week, October 1. When do you think it's going to end?
Well, it's not the first time the government shut down over there, so they're kind of used to it. And it's interesting the way the Trump administration is playing it. They're standing up in front of these lecterns that have Democrat shutdown emblazoned all over them, which is to make a very key point that it's our opponents stopping your government from working, not us. And that's an important message to send because everyone quickly gets frustrated at the thought their government isn't working.
I reckon the other big impact in markets at the moment is just the lack of economic data that's going to be coming out of the US because of this shutdown. A lot of the people that are employed to put the data together, they're some of the ones that have been stood down, Cosy. So we're not going to be getting the week in, week out releases for a bit, which personally I'm going to enjoy because we just get knocked over by the amount of data. Markets move up, markets move down. But you have to wonder how much of it's actually that meaningful.
Yeah, sometimes it's much more worthwhile to stand back and look at the bigger picture.
There's also plenty more AGMs next week, Cosima. We've got AGL Energy is obviously on Friday today. Next week we've got Transurban. On Wednesday we've got REA on Thursday. AGM season's kicking off. Expect to see some trading upgrades and downgrades as companies come out and tell us what it's like out there. And lastly, we've got Australian consumer and business confidence data on Tuesday and Wednesday. Cosima, you get out and meet quite a few CEOs. What are they sort of telling you at the moment, just about how confident they are in the outlook?
I think they're worried that it's a low growth environment out there. And as we kind of saw in earnings season, When there's not a lot of growth out there, what do you do when you try and make your balance sheet stack up? You start looking, where do you cut costs? Where do you cut costs? You cut your headcount, because that's the biggest cost on most balance sheets. And that's why we saw a lot of job cuts come out during reporting season in August. The interesting thing from the RBA earlier this week was that they are seeing consumers wanting to spend a little bit more, so that is good. But we've also seen the price of things like Netflix go up, takeaway meals go up. It's a complex environment to try and navigate, because you tilt too far one way, it goes bad. You tilt too far the other way, it can also go bad. It's pretty finely balanced.
Yeah, the RBA is also worried that business has been absorbing some of the cost increases, and they might be coming to us shortly. Anyway, if you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Cosima, we love questions here on the Chanticleer podcast. This week, our question is from Paul in New South Wales. And if you have a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone and include your name and where you're from and email us. Or you can click on the link on the Chanticleer articles online. So Paul says there was an interesting article on taxes paid by international corporations in the AFR recently, and points out that tech giants Microsoft, Google, Facebook, Apple and Amazon collectively paid $650 million in tax for their Australian operations, while streaming service Netflix paid no tax on $1.2 billion of total income. He says, why are we not dealing with what must be outrageous transfer pricing to get an appropriate tax outcome? What do you think, Cosima?
Well, I share Paul's concern. You know, as you point out, the tech giants paid collectively $650 million in tax, whereas if you look at BHP and Rio, they both paid over $6 billion in tax. That's a big differential, and we know these tech giants are eating a lot of Australian companies' lunch, like the media companies, as we've talked about recently. It is something that gets a lot of Australian CEOs pretty worked up about, the imbalance about it. I know the government is constantly sort of looking at ways to, how do you claw some of this back? But look, these companies have very smart lawyers and bankers who can tell them how to structure their affairs to minimise where they pay their tax. I know the government is now even looking at data centres and seeing if the way tech giants funnel their profits through data centres in Australia is also another way to potentially minimise their tax. It's been an ongoing problem for years, and it shows no sign of abating.
How can Netflix seriously be paying no tax here? You know, my household pays it $20 a month. I'm tipping yours probably does too.
We do,
Cosima, like $1.2 billion revenue in Australia in that 2023-24 financial year. On my maths, that's about 2.5 million people paying $500 a year. I mean, this is supposed to be a capital light, high margin business. That's why its shares trade at 40 times forward earnings per share. It doesn't feel right that it doesn't make money here. I mean, transfer pricing, it's a huge issue in Australia and globally. But all I know is that when you see the published list of who paid the corporate tax, I'm so grateful for the miners. You know, yes, they're digging up Australia. Yes, the inherent nature of their business is hard on the environment, but we're getting two things back, at least from them, aren't we? We're getting tax and we're getting jobs.
Absolutely.
And what are we getting back from Netflix other than another series about a small town cop who's come across an unusual murder? Seriously.
Yes, I think there would be many operators that would agree with you, Ant. And look, we get some cultural enjoyment. That's what I would say we're getting from Netflix.
Well put. All right, Cosima, it's been great fun having you on the Chanticleer podcast today. Thank you very much for coming in.
Thanks for having me, Ant. I really enjoyed it.
If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, Anthony Macdonald, and Cosima Marriner. It was produced by Mandy Coolin and Alex Gow. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.